Good morning to all of you, and a warm welcome to all the participants who have dialed in this morning, and to our panelists. I'm Susan Yavari. I'm Senior Regulatory Policy Advisor at AFAMA. I work on capital markets, and I'm joined by my colleague Pedro Pinto from AFME. And together, we are very pleased to bring you the second installment of this two-part series, so Navigating the MiFIR Review. And as I think quite a number of you dialed in 2 weeks ago, we had the first session, which was focused on market structure. Today's session will focus on consolidated tape and will follow a similar format. So we'll bring you an educational segment to start with, where we want to introduce sort of basic concepts, definitions, and also illustrate a little bit sort of the current market dynamics that we have. In the second half, we want to open up a debate with our panel, which includes buy and sell side experts, as well as a European regulator. So at this point, I'd like to introduce Nikki Beattie, who is CEO of Market Structure Partners, and she will be leading the educational segment for us. I think some of you will already know her, or at least know of her firm of Market Structure Partners, which is specialized in financial market infrastructure. And you will also know MSP from the September 2020 report that they produced on consolidated tape. So she's kindly agreed today to introduce us to some of these key concepts to do with consolidated tape. And I think she'll do a great job at setting the scene for the debate that we will have in the second half. I'd also like to mention that we do have a live chat function, and you're really invited to kind of participate and drop in any questions that pop into your head. We'll either look at them during the presentation and certainly see to them at the end if we don't have time during the presentation. Yeah, and I think with that, I'd like to hand over to you, Nikki. Thanks.
Thank you very much, Susan, and good morning, everybody. And as Susan said, I'm going to take you through some of the basic concepts and some of the jargon about what a consolidated tape or consolidated data actually is. And then maybe just talk a little bit about some of the problems that we have today, what potentially a consolidated tape might actually resolve, and a quick comparison with some other markets like the US. So, Claire, if you'd be kind enough to go to the first slide, please. So there's two types of market data. One is known as pre-trade data, and the other is known as post-trade data. So if we start off just talking about pre-trade data and what it actually is, well, it's the visible bids. So that's the prices at which people are willing to buy something from me if I'm looking to sell either some units of bonds or shares, or the offers, which is the prices at which people are willing to sell to me if I'm looking to buy from them. And it also tells me the volume of units that they're willing to buy or sell at that price. So what you can see on the slide here is just a market, and these are the imaginary bids and offers in that market. And what you see is the number of units. So if we look at the top left-hand blocks, there's 100 units for sale or someone's offering to buy, 100 units at 10 euros. And they're also offering to sell 100 units at 10 euros and 10 cents. And so all the things that are available here that everybody can see that's available is called addressable liquidity. That's a market jargon term. If we go to the next slide, please, Claire. So this is just to show you that we talk about all these different number of units. So what we see down here is there's 100 units and there's 300 units available, 100 units again, and the different prices at which they're available. And we call this the different levels of data. So people talk about level 1, which would be the top level of data, and then level 2, level 3, level 4. And so this is just to give you an idea of the jargon around that and the different levels that people are looking at. Now, in many cases in a liquid market, there would be much more available. So this, as I said, is just imaginary pricing. Next slide, please. So again, looking at that same market, but imagining now that I'm a trader and I need to buy 500 units. Again, this could be shares or bonds, it doesn't really matter. I'm looking at an instrument and I want to buy 500 units. So I'm looking at the price that somebody is offering, the price that they're going to sell those 500 units to me. And what I can see is actually there are 3 levels. So at those 3 levels, I can get 100 units, I can get 150, and I can get 250 units. That gives me my 500 shares or bonds that I want to buy. And then I can add up and work out what the overall price would be for buying my 500 units. And here that would be 5,065 euros with a 50 cents as well. So that's what I'd be looking at when I'd be looking at a single market. Next slide, please. But it's also really important that we're not just looking at prices on here. We're also looking at the entire volume that I might be able to buy. So if I need to buy those 500 units, could I buy them if I wanted to do so today? Now, a retail investor may only have something like 100 units or 100 shares to sell. But if you're a wealthy investor or perhaps a bigger institutional asset manager, you may have hundreds, thousands, or even millions of units of different instruments to buy and sell every day. So you're going to be looking at these bids and offers, and it's going to be telling you what we describe as the liquidity. So the amount of units available to me is telling me the liquidity of the market. Now, if I've got, say, 5,000 shares to sell or 1 million shares to sell, and I can see on this market that there's only 1,025 units in total available, then the liquidity in this instrument seems to be low. And I do need to make some decisions now about whether or not I'm going to sit patiently and hope that other people are going to come along and also offer some of these units for sale. Or I have to actually think about whether or not there's an alternative where I might need to go and do a bigger deal away from the trading venue, and we'll come back and talk about that. So next slide, please. So post-trade data is the data once the events have occurred. So what we've just looked at is all the possibilities out there before I've actually traded. But once I've done the trade that I just talked about, the 500 units, then all of those trades are reported and they are timestamped. The time that the trade occurred is very important. You can see here they occurred pretty quickly, one after another. One was at 10:17 and 34 seconds. The next one was a few seconds later, and the next one after that. Now, this data under MiFID rules or MiFIR rules has to carry some flags on it. So as well as the timestamp, it has things like the name of the venue, the amount or the volume that was sold in each individual trade, and the price at which it was traded. And from that, I can work out, obviously, we only know it was my trade that occurred at this time, but there could be many others occurring. But in the last minute, I can work out what the average price has been and the amount that's actually traded. So with my trade alone, it was 500 units and the price at which I bought. I just want to say one word about historical market data, because we talk about trades that have occurred, and this post-trade market data that I just talked about is what I see immediately after the trade has occurred. But also what people are doing is that they are then gathering historical market data. Now, this is a much broader compilation of data, and it's everything that might have happened in the last months, years, weeks, etc. And it's not only this post-trade information that we've just talked about, but actually it's all the pre-trade event data. So if we looked at the previous set of bids and offers, not all of them might have been executed, but it's still worth me knowing what was available, even if it never got executed. And so people want to store historical market data. They don't normally start gathering that information until at least a day later. So the post-trade data we first talked about is available within minutes, and the historical market data is a compilation of everything that takes much longer to put together. Next slide, please. So what we looked at just now was a single market, but we know that after MiFID and MiFIR, we've got competition and we've got what everybody talks about as fragmented markets. That means the same instrument could be traded on multiple markets, and they're all competing to show their wares to a potential investor. So here we have three imaginary markets: Market A, Market B, and Market C. And what we can see is they're all showing bids and offers, and all at slightly different amounts and different prices. So next slide, please. So it's only if I can have consolidated data that I can actually see across all of those markets. In a world where I don't have consolidated data, I may not have access. I may choose, for example, that I'm going to take Market A and Market B's data, but perhaps I don't take Market C, perhaps it's too expensive to buy the data, so I'm missing that. If you had consolidated data, basically what it would show you is all of the different bids and offers across all of the markets in a consolidated format. So what we can see here is now I can look across all the different markets and I can see, actually, I can get my 500 units at the best prices across Market A, Market B, and Market C. And so if I take into account the consolidated information that I can see, I can now see that I could buy my 500 units for 5,047 euros instead of the 5,065 if I'd only bought from Market A. So this is giving me a much better view of the market in a consolidated format. Next slide, please. Now, we also talked about the amount that is available. So here I can see across all of the markets, if I add up all of the units available on Market A, all of the units available on Market B, and all of the units available on Market C, it starts to look a much more liquid market than I originally thought. So actually, there's 3,250 units available in the market. And this is really important when I assess risk if I'm going to trade. When you want to buy an instrument, you're going to be thinking, not only this is great that I can buy this now, but at some point you will want to be able to sell this instrument. And so understanding how liquid this is gives you an indication of how easy it's going to be able to sell this instrument at a later point in time. And risk managers are often looking at this information to decide how much of something they want to buy and how much they want to keep for the longer term. And it's a very important discussion that goes on inside many firms. How liquid is this instrument? But even a retail investor is going to be thinking about that. Next slide, please. So that was the pre-trade data that we just looked at, the consolidated pre-trade information before I trade. And after I trade, what I get is the consolidated information shown to me of everything that's happened on every market. So again, imagining my trade was the only thing that was happening in the market, it's showing each of the trades I've executed on Market A, Market B, and Market C, my 500 units. And I can calculate the average price, which, as we said, is 5,047. And again, I've got all of the timestamps in there. Now, just a word about the flags that are on here. These are just some of the flags that MiFID or MiFIR asks for. There are many other flags, and the flags are really just the additional information, like we said, it's the name of the venue or the price, etc., that investors might want in order to be able to sort through their data. We go to the next slide, please. So I just want to talk about market characteristics. So we've just looked at bids and offers, and they're relevant in both order and quote-driven markets. And what do we mean by that? Well, I think if you listen to people talk about equity markets, there's a lot of conversations about CLOBs or central limit order books. And these are really order-driven markets. So what does that really mean? Well, it means that participants feed into the system the prices, which are the bids and offers we've just talked about, at which they're willing to trade. So if I wanted to buy or sell something today, I would put my order into the system. And the order would be displayed in the way that we just showed on the trading venue order book. And when I talk about trading venue here, it could be an exchange or an MTF. And the matching of the orders is done automatically by the technology provided by the trading venue. And this is very equity market related. You don't see this sort of order driven market very often in bond markets, except for in very liquid treasury instruments. So this is mainly an equity thing that goes on. And this is where exchanges are adding value by providing that ability to match the orders. The moment those orders are matched, so there's an algorithm going on looking at all the different prices and it's saying, okay, I found something that matches your order. That happens, the matching, and then the trading venue automatically generates the post-trade data when the trade is matched. Now this happens instantaneously, and this is within milliseconds in most equity exchanges. So as I said, this is mostly for liquid instruments and it's mostly for equities, but not exclusively. Then when we have, on the other side, what we have are quote-driven markets. And this is where dealers advertise the prices. So again, exactly the same as we saw before, the bids and offers at which they're willing to trade. But in this case, the prices are not always displayed on a trading venue. They can be, so they could be on an exchange, an MTF or an OTF. But actually the broker dealer could also be publishing this on their own public feed or using another piece of technology, third-party technology offered to display these bids and offers. Under this market, there is no centralized matching of quotes. So there's nobody standing in the middle providing an automated matching engine, and negotiation is still required with the dealer. Now, sometimes that negotiation is by computer and some of it maybe even over the phone. And the bigger the trade, the more likely there is to be a manual discussion about it. So I think we've lost our slides. Can anybody else see the slides? I just asked.
I think she'll come back in.
Okay, hopefully. Hopefully it wasn't so boring that she nodded off. Claire, so would you mind just going back one slide, please? Claire, are you there? Would you mind just going back one slide? Well, it doesn't really matter, actually. So basically, what I was just finishing off on was around the quote-driven markets. And the last point really is because it's not an automatic matching engine, there's an extra step that needs to be taken, which is reporting the trade. So if you're not trading on a matching engine or a central limit order book, then there needs to be a mechanism under which you actually report your trades. And so under MiFIR rules, post-trade reports must be sent if they're executed outside of this trading venue central limit order book, then they must be sent to an approved publication arranger. So this is somebody who aggregates the trades. And just what I want to say in here is usually both markets have a hybrid of these going on. So for very illiquid instruments in equities, you would have some quote-driven markets also going on. And as I said before, in liquid instruments in bonds, of which there are not many, you might have an order-driven market going on as well. But usually both markets have some sort of hybrid. Okay, Claire, next slide, please. So we just talked about the trade reporting. So I just want to show the flow of what actually happens. So you have investment firms and dealers at the top of the flow. They're putting their orders and quotes, their pre-trade data, as it's known, either into a trading venue, or if they're displaying their own quotes, then they may be putting that into some sort of proprietary feed. Once the information goes into the trading venue, the information in the trade is automatically reconciled. And by that, I mean the trading venue knows who bought and who sold, and it can reconcile both sides of the trade. So it knows that the data is accurate. And that information is instantly available in nanoseconds. On the other side, what you've got is the investment firms and dealers having to send their off-venue post-trade data where they haven't executed via central limit order book through to an APA. Now, this is meant to be available instantaneously, and it is generally, but when we say instantaneously, it's generally seconds or minutes. And in bond markets, it just is slower because of the nature of the way those markets operate versus equity markets that are very fast. Next slide, please, Claire. And then finally, what we know is both APAs and trading venues, they're acting as aggregators of certain amount of information, but there are multiple trading venues and multiple APAs. And the idea under MiFIR was ultimately that all of that information would drop down into a consolidated tape provider. But what we all know is that no consolidated tape provider has emerged. And we'll go on and talk about that in just a second. But if we go to the next slide, I just briefly want to touch on speed of data, because that's something that we've just talked about in the reporting of trades. So speed of data delivery is very important in every market, but there gets a lot of discussion about it and about latency in the equity markets. And what does latency mean? Well, latency is the speed at which a participant can receive data and also the speed at which they can place order on a venue. It's no good if you can get data very fast, but you can't place orders quickly. And so very fast moving markets are known as low latency markets. So on this arrow that goes from green to red, I've just put an illustration here about the speed of markets, because there's been a lot of discussion not only about low latency markets, but also whether or not we should have 15-minute delayed data as sufficient for market participants. So on the left-hand side, what you can see is really at one end of the spectrum, we now have data delivered in nanoseconds. This is faster than the eye can actually see. Now, this data is useful to a very small number of market participants, and these are the high-frequency traders who are making markets on, so they're providing a lot of the information about bids and offers and using their own financial capital to support the market making in that. It's very important to them, because they're taking risk of their own money, that they know very, very quickly what's going on in the market. And they are willing to pay a premium to get this data. To be honest, all they do all day long is trade. So this data, in being very fast, is important to them. That's the only way that they make money. But for most market participants, receiving data in milliseconds, so pretty much as the naked eye could see, is sufficient for most participants. And that's because they're not making money just from market making all day long. They're actually buying on behalf of investors, or a retail investor is buying for themselves. And they're not thinking they're going to sell it a nanosecond later. They're actually thinking about investing for the longer term. So for most people, this millisecond data is sufficient. Now, this discussion about 15 minutes, well, okay, there's not much of a difference between nanoseconds and milliseconds. But 15 minutes between when one person receives data and another person might receive it is in fact a lifetime in very fast moving markets like equities. And on average, about 3.5 billion euros is traded every 15 minutes. So imagine a scenario which has happened very recently where EDF, the French electricity company, has had prices capped in certain markets because of the situation in the Ukraine. Now, imagine that you wanted to buy or sell shares in EDF. Within milliseconds, that information is known to the market. Why would you want to wait 15 minutes while everybody else is trading in nanoseconds or milliseconds in order to know whether or not you should be doing your trade, or how well your trade might be doing? It's like being invited to a party and arriving after everybody else has been at the table and they've just left the crumbs there. So there's a very big difference between milliseconds and 15 minutes of data. There's very little difference between nanoseconds and milliseconds. Okay, thank you, Claire. If we can go to the next slide. So obviously, we will all be asking ourselves, well, why is there no consolidated tape? Well, the first reason is the data quality and the lack of enforcement of standards and rules. So what do I mean by that? Well, MiFID and MiFIR never gave us any technical operating standards or tools with which to report data. So everybody might be using a different technical standard with which to report their information to the central or the consolidator of the information. There are also ambiguities in the rules. So people are interpreting the rules differently. So one person may report something in one way, some person may report it in a different way. There's also incorrect use of the flags. If you remember, I said there are numerous flags that have to be appended to the data, and people are not using the flags correctly in there. Additionally, there's no reconciliation of the APA data. So as I said, reconciliation happens on central limit order books, but for everything off the order book, there is no reconciliation. And by that, I mean, actually, there is only one side trade reporting, and so nobody can see whether or not there's another side to the trade. And if there is, you might actually see that somebody has double reported or reported a trade 15 times. These things happen all the time. They may not be deliberate, they may just be accidental. But if you don't reconcile the data, you can't actually see the problems. Also, APAs particularly, but even trading venues, all give their data in different formats. So if you're trying to consolidate data, one venue may, for example, give you something that's machine readable. Somebody else may just give you a PDF that has to be manually transposed. So it's very difficult to bring all this together. And then finally, in the bond market, we have this issue with data deferrals, where each nation can decide how long somebody may defer reporting their data for when they've dealt in bonds. Now, for example, in Denmark, this is done in real time on the same day, but in other markets, it may be 3 weeks before you see the bond information. This makes it really hard to compare different bonds across the market. So the data is pretty useless if it comes in different times. Now, the even bigger problem behind all of that is that there is no enforcement of standards and rules. Well, what do I mean by that? Well, there is no single body with a central view of all of the problems. There is no centralized penalty mechanism. So what do we do even if we see that somebody is actually reporting data wrongly? APAs are commercial organizations. They want to win the business. They don't really want to penalize their customers, so they're unlikely to do that job. So who is meant to, and what is the fining mechanism and the way that we're going to penalize people for poor data? We also have, as we know, across Europe, a federated model of supervision. So even if somebody does something wrong, do we then have to ring up the French regulator or the Dutch regulator and say, can you go and look into this? How long will it take? By the time we actually get through all of this, it could be 2 or 3 years. And this is real-time data that the market is trading with that we've got a problem with. And finally, there aren't any consequences for poor data submissions. So without this body, without clear enforcement, well, who cares whether or not there's bad data in there? So people are just going to continue to put poor data in there and not fix the problem. So that's one of the issues. The second issue, Claire, if you could go to the next slide, please, is cost. So at the moment, there is no mandated contribution from all of the venues to a consolidated tape provider if one existed. So what does that mean? It means that nobody is mandated to give up their data. And in fact, anyone who wants to consolidate data must incur a significant number of implicit and explicit costs. They have to go and negotiate fees and legal contracts with every single venue that is out there. And they have to do it pretty much on the terms that that venue wants to do it. It's very hard for them to create the terms alone on which they want to negotiate. So if you imagine this, well, this is actually true numbers. So in bond markets, this would equate to 313 different entities. So what you see underneath is the bond market number of regulated markets, the number of MTFs, the number of OTFs, and the SIs that fall into the APIs. So I would have to negotiate with all of those different entities in order to get a consolidated view. And in equities, it's a slightly less number. It's 198 different entities. But not only do I have to take all of the data from all of these, I have to normalize or harmonize all of this data. So as I said earlier, there are no standards, no technical operating standards, etc. Somebody has to go through and clean all of this data to make it useful and comparable. So there is significant cost in doing all of this. And then the third problem, Claire, if you would go to the next slide, please, is that actually the consolidator today cannot set the price at which the data should then be sold. So basically, if I want to consolidate data today, I must either absorb all the individual data venue fees myself, or I have to pass them on. And so it's pretty unattractive to absorb those fees myself. So I'm going to pass them on to the users. And the problem is that the value that a single venue puts on its data may not reflect its true value when consolidated. So what do I mean by this? Well, what we've got in equities is a classic example where the dominant national exchanges used to have 100% of the market share, and therefore they sold their data as if it was, because they had 100%, they sold their data at a high price. They may only have 70% of the market share now, but they're still selling their data for a high price. And if I'm only looking at that data, then it's still very valuable. But if I can see the other 30% of the market, then the price at which they want to sell me their data may not be so valuable when it's consolidated. And we have this situation that if individual fees get passed on, then users start to select a subset of data according to their budget. So actually one person decides, well, I'm only going to look at market A, another person decides I'm going to look at market A and market B, somebody else says I'm going to look at market A, B and C. And what we have is the problem that nobody in the market has the same or complete view. And that really matters when people are talking to each other and saying, well, I want to buy X%, or I think I can buy this on one market versus another, and my broker says, no, I've got a different picture to you. So it becomes a very big issue. So those are the main issues why we don't have a consolidated tape today. Next slide, please. So people ask, well, who's going to use a consolidated tape if we had one? So this is just showing you all of the different numbers of organizations out there where there is significant demand for a consolidated tape. And these are all taken from public European available reference place sites as to where the numbers are coming from. So what we can see is, for example, that we have a significant number of issuers who are all issuing bonds and equities. There's 9,321 there on the left-hand side. I'm just picking out some of the numbers there. If we look at the end retail customers, there's 15.5 million active retail customers in Europe who would benefit from this data. Obviously, financial intermediaries are going to be very important, and we have what we call the buy side, which is mainly all the asset managers, and the sell side, which is all the broker dealers. And we can see that we've got jointly about 15,000 financial intermediaries. So if you imagine, even if one person in each of those organizations was using this consolidated data to do their job, there would be a significant number of users. If you start to say 10 people in each organization, then it starts to really multiply and be very significant numbers. But there is a very broad range of potential users of consolidated data. We tend to think it's only the people that appear in the films trading on screens that are using data, but really they're a very, very small number. There are masses of people in these organizations who are doing different jobs who need to be able to use market data to do their jobs. And we'll talk about what some of those are in the next slide, please. So some of the jobs that people are doing where they would be using consolidated data, well, anybody who is involved, for example, in issuing a bond or a stock, they constantly need a benchmark, a comparison. They need to see what the rest of the market is doing to ensure that they're going to get the best price when they're issuing. They want to see across the whole market and not just on one market alone. Then you have very significant decisions being made by asset managers and pension fund holders about how much they might want to allocate to different assets. So they want to be looking at things like the liquidity, the depth of the market that we talked about earlier, whether or not if they buy this instrument, they're going to be able to sell it. Those sorts of decisions are very important for them. They would be referring to the market data all the time and looking at all of this. Then we have the pre-trade analysis, the in-flight management, and the post-trade analysis. And this is really the trade execution. And I think if you listened to the last webcast we had, one of the presenters or the panel described this as being like navigating on your way on a road trip. So the pre-trade analysis would be deciding, well, this is where I want to go. This is the trip I want to take. Looking at those bids and offers I saw earlier and assessing what's in the market. The in-flight management will be, well, okay, I'm seeing there's a bit of traffic on the way. I might actually want to turn left or right and take a different route because basically what I'm seeing in the market is actually more liquidity is becoming available or less, and I need to change my trading strategy. And then the post-trade analysis is really, well, did I do a good job? Did I get the best execution? And these things are constantly iterating as a trader is doing their job. Those are the things that are probably most common we imagine people are using data for, but there's all sorts of other things going on. Once a trade's been done, it has to be cleared and settled. Things have to be valued. There has to be collateral and financing moving around. So, sorry, financing has to be done. So collateral has to move around to fund the trading. And then we have the classic things like market surveillance, risk management, and performance measurement going on, and then regulatory oversight. And the important thing is that every firm has a risk management line of defense. So the people in the top 8 number of cases there are all in the first line of defense. They're in the front office, they're doing all the trading, etc., making the initial investment decisions. But the people in the second and third line of defense, they exist to challenge, to look and make sure that people are doing their jobs properly and that risk is being managed. So it's very important to understand that this goes throughout all of these organizations and not just on the trading floor. And then finally, the last use case for this is, in fact, to help reduce impact on the environment. If we had a consolidated tape, all of the things I've been describing where people are trying to process their own data in order to see what's going on in the market would be actually produced in one place, and it would reduce the amount of data processing going on in the market. Next slide, please, Claire. So just to talk about the impact, if we had clean, consolidated data, what would the difference be? Well, it would be better trading outcomes. So this is just a random real-life example of Munich Reinsurance stock and trading on a day which was in December 2019. Sorry, it's not more up to date, but it's so difficult to get this data that I've used one where we know that the data is completely correct. So what are we talking about in the current situation? Well, what we're really saying is it's really hard to get clean data at the moment. And I talked about data quality. And so what that means is if you get unclean data, it may include incorrect trades where they've been double reported or triple reported, or they've been poorly labeled. And so what can I see in view A here? Well, what I actually see here, this is all the trades that I think have happened in the market, but the data has not been cleaned. And what it tells me here, if I'm trading Munich Re as a stock, is actually the lit order book accounts for about 35% of trading that is currently occurring. And if I look further down, it tells me that systematic internalizers are doing about 51% of the market. So if I'm going to have a trading strategy now and I'm only looking at this data, it would lead me to believe that of the order that I want to place on a market, I should only put 35% of that onto a lit order book, and I should put the rest, more or less, onto a systematic internalizer. Now, when that data has been cleaned, and it is very complex to clean this data, it really means that billions of rows of data have to be filtered for mistakes and corrected. There are not many people that have the capacity and the budget to be able to do this. But if I look at this data when it's been cleaned, actually what I see is the lit order book accounts for 70% of the trading that's gone on in the market. And there's a whole load of poorly labeled trades that actually have now been cleaned that tell me that SIs only account for just under 4%. That would mean I would have a totally different trading strategy. And if I hadn't been able to see this data, I would have followed what View A had suggested to me to follow. And I might find that I hadn't actually managed to execute my trade. And really, I should have sent the majority of it to a lit order book. So the trading venues would have benefited from this information being available as well. The other things that might be benefits, if you could go to the next slide, please, is in relation to competition. So at the moment, not everybody can see what's going on in every market. And this is just a calculation on here of everything that happened in the Danish index during the month of December 2019. So it's looking on average on the left-hand side, which were the venues displaying the largest amounts of liquidity at the best prices. And what we can see here is they go down in order. There was venue D offering the most, venue A then offering the second most, venue C the third most, etc. But actually what happened when those trades got traded is the proportion of trades that were directed to venue C were greater than to venue A, despite the fact that venue A clearly had better prices. So that means people can't see everything that's going on in the market, and venues that are competing and have good prices and good liquidity are not actually being rewarded for having that available. Next slide, please, Claire. So finally, just a quick discussion, which hopefully will segue into the panel discussion, but really, how do we compare with the US market? What do they have that we don't? Well, they have a single source of consolidated data. There is only one place to find that information in both equities and in bonds. Now, we don't have that in European equities or bonds, and actually the current language is talking still about competition, which would mean we would have multiple sources of consolidated data. So that's one difference. The US also has a single body to govern, administer, and enforce standards. And again, we are not talking about having that. We don't have it today, and we're not talking about having it in the latest MiFIR review. One of the things that I find quite interesting as well is that in order to have a license to be a broker-dealer in the US, you have to be a member of the entity that manages the off-venue dealer data. That means there are consequences if you don't follow the rules. You lose your broker-dealer license. That's pretty serious. So you're going to make sure the data that you report is going to be good, clean data. And if you don't, then they fine you pretty quickly. And after a while, they can throw you out and you don't get your membership anymore. We don't have a concept of that now, and we're unlikely to have a concept of that under the MiFIR review. They also have mandated contribution to the tape. So the data is freely given up to the tape. It doesn't mean it's sold for free, but it means it is given up without lots of negotiations and legal contracts or different fees being charged by different venues. They have to send it to the tape. Now, we are talking potentially about having something along the lines of mandated contribution in MiFIR. I think the big question is then whether or not we will also have the price of data determined by the central tape administrator. So in the US, once that data has been freely given, then the central body determines the price at which the consolidated data is sold. Now, if we have competing venues in under MiFIR and under the MiFIR review, then it will be harder for that to occur. They also have a revenue share for all contributors to the tape according to the value that they bring to the tape. So there's a very clear mathematical calculation that actually, this is mainly in equities to be fair, but there is a clear calculation about how much you have provided in good prices and then whether or not you get a share of the revenue as a result of that. And this looks at both pre-trade and post-trade information so that there is a fair revenue share across the people who have provided the best prices. It's not clear that we are going to get anything along those lines under the MiFIR review. And then finally, they have revenue incentives to encourage price making in illiquid instruments. This means that actually, if you are providing data in illiquid instruments, there is for example, a double or treble the amount of revenue you might receive in order to encourage people to make prices in those less liquid instruments. So there are ways to reward people for different things. It's not all considered perfect the way this works, but I think it's just useful for us to compare with the US market. And that is the end of my presentation. And so, Susan, I will hand back to you for, or Pedro, for the panel discussion.
Thank you so much, Nikki, for a very clear and enlightening presentation. I hope our listeners enjoyed that. I think if we walk away with one thing that you've demonstrated effectively is the major gap between the data that we have today and the data ideally that we would have under consolidated tape, that full and complete picture of prices and volumes. So, and then I think you also showed us that it's a broader universe than just the buy and sell side firms. There's many more consumers of data than what we would imagine. So I think a very nice point to move on to the panel and to hand off to Pedro to introduce our panelists. Thanks.
Thank you, Susan, and good morning, everyone. Also, thank you, Nikki, for the very clear and indeed insightful presentation. My name is Pedro Pinto, and I'm the head of MiFIR for AFME. I'll be moderating the Q&A sessions of today's seminar. As Susan said, we hope that the first part of the seminar have already clarified some key points of how the consolidated tape works in practice and why it's important, but we'll try to clarify why the consolidated tape should also be a key policy objective, and we'll try to do that during the Q&A session. We have roughly 45 minutes, so the lineup of speakers today is of high quality. Besides Nikki, who's joining us for the panel, and Nikki is the founder and CEO of Market Structure Partners, I should say, and is probably the person that knows more about the consolidated tape in the EU. Anyway, we'll have three more panelists. Representing AFME membership, we'll have Matthew Coop. Matthew is the global head of cross-asset market structure at Barclays, and he always speaks his mind, so it's a good indication for a good discussion. Representing AFME's membership, you will certainly enjoy hearing from Keshava Kastri. Keshava is the managing director and head of capital markets at DWS. And later, we'll also have the pleasure to welcome Philippe Guillot, who is managing director and head of markets and data at the French regulator AMF. Before we start, I should remind everyone that Nikki indeed has done a lot of work on the consolidated tape. She drafted a 200-plus page report for the Commission on the tape, which is an achievement in itself. So please feel free to raise any questions you may have to her and to the other panelists as you wish. You should be able to see the Q&A tool on the right-hand side of your screen. So just type the question there, and we'll aim to respond as soon as possible. And with that, and without any further ado, let's just jump straight to the Q&A session. Nikki has already provided a lot of practical information on how the consolidated tape works. But let's now try to think about the tape from a policy perspective, starting maybe with a very basic question, if I may. So, Keshava, maybe starting with you, why is it important to bring a consolidated tape to Europe? If you think from your business perspective as an asset manager, but also in the context of the wider EU policy objectives of completing the CMU, the Capital Markets Union, and the Commission forthcoming strategy for retail investments, why would you say the tape is important?
Thank you, Pedro, and thank you for having me. And also, thank you, Nikki. That was a very enlightening and insightful presentation to really look at what's been happening and also comparing that US and Europe. It's a great question, Pedro. We obviously had this discussion, in the past as well. We actually, Susan and Pharma organized a meeting, even with Professor Hubner, looking at this. I think it's in two different angles, from a fund management and the buy side perspective. When you're looking at, especially, let's say, index management, right? So when you are tracking an index, you would be buying typically when there are, our investors as a fiduciary manager, we get given assets to be managed by our clients. And when we are tracking an index, so this could be an index fund, it could be an ETF, and various other kind of wrappers. There are certain criteria that we look at, in investing in the underlying assets. So one of the things that we look at is basically the criteria is the liquidity of the underlying basket. So if you take a very large index, maybe let's say a small cap or a mid cap index, we would screen what is the liquidity available of those underlying securities for us to invest into. And there are practical examples, and we've highlighted this before, and there's plenty available in public domain, where you look at, especially when you look at what the European Union and also the policymakers are trying to support, the capital flow into mid cap and small cap securities. And this is where those securities get optimized out in the investment, because the visible liquidity that's available is not known to fund managers. So if they feel like there is too much market impact or there's not enough liquidity available, and they typically tend to be these small cap and mid cap stocks, the exact stocks that the policymakers and the capital market is trying to assist and have the capital flow going in. So those securities get optimized out. So there's one angle there. Second angle also is that Because why do they get optimized that? Because their portfolio manager does not get to see what is the total volume being traded for that security. As Nikki said, obviously there's post-trade transparency. This is MiFID 1 and MiFID 2 has made it even more stronger in many securities, but there's no single overall view. And as we saw from Nikki's presentation about the fragmentation in the venues, it is, especially for the buy side, unless you're very sophisticated, some of the largest buy side institutional clients like ourselves, it's very difficult to get a full picture. It's very, very difficult. The second angle is that from a liquidity perspective, ESMA and some of the other mandates where if there's a redemption coming along, you need to be able to liquidate to get the assets out. We also look at what percentage can we buy off that visible liquidity. So if you only see X compared to a Y, which is a bigger number, so you only see a smaller number, a percentage of X will be invested rather than a percentage of Y, which will be much bigger. So again, the capital flow into these securities are being limited, even when they don't get optimized out. That's a significant challenge that exists for even institutional clients. As Nikki said, for retail clients, and we'll touch base on one of the questions later on the retail side as well. But there are significant. And then you look at ETF wrappers. By the way, this is where, as a UCITS ETF wrapper, it is a significant benefit and an efficient wrapper to global clients outside of the US, because of double tax treaties that some of the regions like Ireland have with global countries in terms of the dividend tax. When investors invest into UCITS ETF, it's actually much better for them in annual performance basis because of that double tax treaty agreements. But many clients globally still are going into US ETFs, though it's actually inefficient or it's actually not giving the enough performance to them because of that transparency that they have and the confidence that they have. We estimate, and obviously it is an estimate, more than $1 trillion worth of AUM in ETF wrappers in the US compared to the UCITS. It includes even European asset managers who buy some of the US exposures, though it's actually more efficient and more performance, especially in this low yield environment, to be able to do that. So the data points are many, and we are hurting both capital flow in the asset management industry in the fund side, but also we are hurting the capital flow in the underlying securities, and that due to the underlying securities that really need that capital flow. And you can see why when people want to do IPOs, they go to the US to do IPOs. You'll have a Dutch company, you'll have an Irish company, they have a great view, they start here, and looking at IPO, they say, where are you going? I'm going to the NASDAQ, I'm going somewhere else, rather than listing it here. And we did some analysis also on some of the clients in retail and institutional clients, when they want to go into a tech industry investment, they don't look at the tech industry stocks in Europe, they actually look at Amazon and Netflix, and again, the capital flow from a retail investor when they're going through their mobile app, they're going through to single stocks and execution in US securities rather than European securities, though there are significant securities available. I won't take up too much. I'll go hand over to Matthew as well, but there are a number of points we will touch base on over the course of the panel.
Well, for the course of the panel, indeed, and you mentioned a few that is clearly worth noting: visibility, capital flows, potentially more liquidity, global visibility, and indeed retail investor participation. That's all from a buy-side perspective. But maybe Matthew, you always brings a lot of perspectives. But maybe if I can ask you to bring the sell-side perspective, your views as a bank, retail, and an investment bank. Why do you think the consolidated tape is important from a policy perspective as well as from a business perspective?
Look, I completely agree with what Kshitala said, because I think I have the great opportunity in my role to speak to clients globally and see the different elements that are coming out of it. And one of the elements that definitely feeds back is it's kind of job security for me, but the complexity of the number of data sources that you see in Europe and trying to explain it to clients, you kind of get the challenge of, I don't quite know what's going on here from a European perspective. So I totally agree with that sentiment. But I think the first thing that I would say as a consolidated tape is actually it's around the democratization of data and the ability for the end investor to be able to visualize and have that freedom and the ability to see data and what is being traded. And that, as Kshava said, unlocks the opportunity to be able to invest into EU markets, which I think is critical. I also think alongside that, and as an investment bank, a systematic internalizer, a major liquidity provider to the markets, it's always to focus a little bit on the bond side of things. No one in the market in bonds actually has good access to data, because particularly from a European side of things, because the data is so fragmented. There are data quality challenges, as Nikki put out there. And I think having a centralization and aggregation will be able to sort of enable good data out there for everyone to be used, whether that be sell side, buy side, and vendors as well, who can create innovation in the marketplace. So I think having good quality data, which is well calibrated and protects the provision of risk across all asset classes, I think is really, really important, and will provide just a serious benefit and be able to democratize and open up the European markets for investment, and for people for end investors to have confidence in terms of what they're buying.
Thank you, Matthew. That's also very clear, and we'll unpack all that later in the session. Maybe Nikki, getting back to you after that very good initial presentation. Over the last maybe couple of years, you went through a lot of discussions, a lot of detail. As I said, you produced a very long report for the Commission. Certainly, you discussed with the Commission the overall objectives they are aiming at. Why you see from a policy perspective, why you see the tape being such an important tool for the future of European capital markets?
Well, I ask myself, if we want a capital markets union, how can we afford not to have a consolidated tape? And I think what we just heard from both Kshava and Matthew is, at the end of the day, and I heard this endlessly from the people I interviewed, is people are allocating capital conservatively to our European markets because they can't see the whole picture, and there's too much risk for them. If they can't see the whole picture, they're not really sure, they're confused, and so they're basically saying, I'm not going to put my money there, or I'm going to just put less money than I would have otherwise done there. And then this is leading them to go to markets like the US, where actually they've got a clearer picture of everything that's going on. So I think it's really important in terms of capital allocation. That's going to help issuers. The other thing is that, we've got a lot of distortions in the market structure at the moment, because some people manage to get all of this data and clean these billions of rows of data that I talked about, but very few can manage to do that. Why is it commercially good for any retail investor or organization, financial intermediary, to be dealing with poor sets of data or trying to spend endless budget on cleaning it up, when actually we could just have it in one place as a place of reference for everybody? So I think to achieve the ultimate policies and goals of Capital Markets Union, this is just a fundamental underlining piece of structure that we need.
Indeed, I think most of us share the same view. I saw you, Kshava, nodding very, very profusely. Do you want to come in and maybe sort of, you already elaborated a bit on why is this important to liquidity? Why would the tape bring more liquidity? Maybe from that equities perspective, can you maybe elaborate a bit more on the points you made about?
Absolutely. I mean, this is the other thing that we have post-trade transparency, so the data is available. It's just not available in one place. And we are, one of the buy-side institutional clients I was speaking to in the US, they were saying that clearly what we're debating now is that yes, there's transparency, but we don't want to show it in one place. And they were so perplexed that we will be debating this for so long that we want to make it more difficult. So what Nikki was saying, it's so much resource, time, and cost inefficiency to say, okay, you do this, whole consolidation yourself, and also for the regulators, not just for the buy side, but also for the regulators when there are things like the COVID happens, to look at what happens as the integrity of the capital markets. How was the overall behavior in securities market? How was the capital flow happening? But also look at the current crisis, over the last few weeks, when a manager is basically, as we all remember, intraday, there were depository receipts that were being suspended to trade, whether it's in the local markets or in the global markets. The LSE was suspending some of the depository receipts related to some of the countries and some of the companies. So was it in Deutsche Börse and so on. And if you're looking at, execution from an equity perspective, you are taking, as Nikki was saying, this nano to milliseconds is very little difference, but milliseconds to 15 minutes, be the time when a deposit receipt stops trading or the liquidity suddenly disappears. You need to allocate. You want to get, in liquidity is like air. You don't realize how important it is until it disappears. And you want to have that, real-time information to be able to form your execution strategy and execute so that you can manage for the clients. And this is where, when you look at overall the consolidated tape, the amount of information it will give you to drive that, to achieve. And again, there is, some of the questions people ask is, is it for retail or for institutions? Actually, if you look at the institutional market, most of it is for retail at the back end. If you look at pensions, they're managing money for retail at the back end. You're looking at insurance, it's again, if it's home insurance, car insurance, life insurance, it's retail behind. Private banking, that's retail behind. Sovereign wealth funds, they're managing for the entire country. So it is driven by retail behind that as well. And when we are managing asset management, fund management industry, whether if it's active or passive, whether if it's active management, fund management, or the ETF on exchange, by default, they're retail. Again, retail makes up, as Nikki was saying, when you look at the cleaning up the data, what appears as one, but if you really go into the detail, you will see it helps much broader capital markets union. And this is where we can really help grow that confidence and the number of clients globally, even US clients where we have certain exposure, certain equities that can come into this, but they're not coming in. As I said, we had a discussion with a Korean client a few weeks ago where they wanted to invest into a particular product. European products give them near 35 basis points a year extra performance. And actually, as an overall, it's significantly more when you look at the percentage point. But, nominal value of 35 basis points, but they still went in and bought a US product because of the transparency and the confidence that they get, that I can see everything, as Nikki was showing, there is, overall volume. So I think we are hurting ourselves in multiple angles. And this was actually highlighted when you look at the equity market volume over the last 3 years between APAC, Europe, and the US. In notional terms, over the last 3 years, European volume is flat, whereas US and APAC have more than doubled or tripled. Susan and I did a session with Professor Donato Hubner, and the percentage of the equity volume globally for Europe has been declining. So we as a capital markets, what we're trying to do is grow the capital markets because of our fragmentation, because of overall transparency difficulties. We're actually hurting our own kind of growth and the capital flow.
Thank you, Keshav. And I think you made a very good point. We all agree that ultimately behind any investor, there's always a retail investor somewhere down the chain. You have been addressing this topic more from an equities perspective, but I think Matthew would love to address it from a fixed income perspective, and how the tape would bring or would make more liquidity available and eventually even promote retail investor participation on fixed income markets. Matthew, any thoughts? I'm sure you will have many.
Look, I think when looking at fixed income, I think what we need to look at what do we have at the moment. And essentially looking at the fixed income markets, MiFID II brought in the biggest transparency regime we've ever had in this world. Bigger than any US regime, everything. The scope of instruments is massive. So we have a ton of transparency out there. However, when we look at it, particularly in fixed income and cash bonds, across credit and sovereign bonds, no one's really using it. Why is that? So generally, as Nikki pointed out, there are a lot of data challenges in terms of data quality. Amazingly enough, I have spent a number of hours in the debate around what is the price of a bond. It seems quite crazy that you're actually having that debate, but actually when you're looking at a bond, it can be priced in a number of different ways and down to the function of how you're actually trading it as well. And so, but if you're having that kind of discussion, that in terms of what is priced, there is a fundamental issue there in terms of the data for a subset of the trades which are being printed. So we've got an issue in the sense that we have loads of data out there in the European market, but no one's using it. I think in terms of every single call that I have with clients when I'm engaging across industry conversation, the conversation around a consolidated tape and the growth of transparency for bonds is on there as kind of the number one topic. And particularly with clients wanting to be able to get information and pricing information so that they can understand where the market is. The bond market is different to the equities market in that the way that liquidity flows is through the provision of risk. So, i.e., us as banks providing risk provision to our counterparties in the buy side. Because the liquidity is not widely available and the nature of how a bond is issued and how it trades is completely different. So you don't have the all-to-all connection of what needs to happen. And so you generally need an intermediary to sit there to put their balance sheet up there to be able to facilitate that transaction to happen. That means due to that means bonds have for quite a lot of time can be very illiquid. And so having historical and having useful information, that is very powerful for us in the sell side, but also for buy side as well, to be able to understand and to be able to look at, okay, if I need to trade this, what potentially could I actually get out of it? There's no immediate liquidity for right now. Because that is a phone call or a request for quotes to a counterparty to see which risk you can provide. But it does help in terms of the management of this. And as Keshava was saying, in terms of if he has a redemption on a fund and he needs to liquidate something, how can I actually get out of that position? And what is the likely impact of that actually happening? And I think that is going to provide a significant benefit to the market. The transparency around that enables, that sort of confidence or the estimation of where someone could trade and to provide that benefit coming through from there. I think the other thing is, when we're looking at the aggregation, if we aggregate it and we make it available at a single point, it is going to start people to be able to use it, and we're going to start working through the issues that we find. I see it like the evolution of human. You have the birth. We have had that birth in MiFID II, and in from fixed income, we have been born. We are developing, and we are starting to learn to walk. And so the critical thing now is actually sort of working through that and being able to develop effectively so that we get good, effective transparency out there to actually deliver a good market.
Thank you, Matthew. That was extremely clear. We should never forget, of course, that fixed income markets are very different from equities, and you provide just the perspective that everyone needed for bond markets. Indeed, I see the questions start coming. There's one question that we may try to answer later during the session. I would just remind everyone that you can just write your question on the right-hand side of your screen, and we will try to respond maybe over just 5-10 minutes at the end. But maybe before that, try to bring you back to the discussions around if this is so good as you say, and I think we at EFAMA and AFME share the same views. Why are people still opposing, and I may bring you all back to the equities consolidated tape, why are some people opposing a pre-trade tape for equities? It seems it's welcome from the buy and the sell side. What are the complexities that we all should be aware of designing while we design or try to design this tape or try to help the Commission and the policymakers design a pre-trade transparency tape for equities, what are the complexities? What are the advantages? Nikki, you already mentioned some relevant points on your presentation. In a nutshell, what did you say now from a policy perspective, and why is it important?
So maybe I can just make an analogy. When I was writing the presentation that I gave earlier, and I was thinking about, how do I make this easily understood? And really, I mean, we all use consolidators all day long in our lives. We go to booking.com when we want to look for hotels. We go to Skyscanner when we want to look for airlines. It's so much easier, isn't it, when we can see everything that's available rather than looking on one company's site. And a consolidated tape is similar to that. But pre-trade versus post-trade. If you imagine the booking.com example, if we just have post-trade data in equities, it's like saying, actually, you made your booking, you went to stay somewhere last night, and you wake up in the morning and you look at the information and it says, well, these are all the other people who stayed in the hotel and the prices they paid. Well, wouldn't you like to have known that before you actually made your booking? So actually, the philosophy behind pre-trade and post-trade, to me, I just can't understand why we wouldn't want pre-trade data. So what's holding it back? Well, obviously, there is the vested interests of the organizations, which are mainly the exchanges that are selling pre-trade data today. And if, to be honest, they had to put it in consolidated tape, the competition would be much clearer between all of them, and some of them may actually lose market share to other markets. And I think in one of the examples I showed that, some of the market share should have gone to a venue that didn't receive it, even though it had better prices. So unfortunately for the exchanges, there's the two-sided thing. There's this threat of competition for them, and also the revenue is under threat that they earn for both pre and post-trade data today. So everybody says, oh, well, let's just start with post-trade data. I agree in bonds that might be a different conversation, but as you said, this is an equity question. And so for pre-trade, for me, it's a no-brainer. And people will say, oh, it's too complicated, we can't deliver this in milliseconds. But the analysis that we did for our study, and we spoke extensively to technology providers, is this is not a technology problem. There are hundreds of technology firms that can provide data in milliseconds today. This is a governance, a data quality, a cost problem that needs to be resolved. So I saw one of the questions on the panel, to the panel from one of the attendees, was about the ongoing efforts by private providers of a consolidated tape. What I'd like us to discuss that in a bit more detail, but what I would say is everyone keeps thinking the private provider should be a technology company. Well, that is just one aspect of it. We need somebody who can administer, govern the tape, etc. So actually, technology is not the only problem. And as I said, this could all be delivered in the milliseconds that is required quite easily.
I mean, people are looking at, atomic settlement, T0 settlement, literally real-time settlement. And I think taking data available and giving it in real time from multiple sources, I'm sure Matthew probably has a few people who can do that over the weekend, probably design a new system.
Yeah, no, I mean, look, I think Nikki summed it up. I completely agree. Everyone is investing in data and information because trading is about information and data, and it's about understanding what is happening in the market and trying to predict what's happening to get ahead and to make sure you get the best performance. I think the critical thing is Nick, as Nikki said, you've got some very commercial vested interests here. From my perspective, I strongly believe that a role in market structure is a custodial role in terms of the industry, and you can quite easily make it a very commercial role and trying to look at your own vested interest. But actually, fundamentally, I think that is very wrong. And the critical element when you're looking at market structure is you need to look at what is happening for the right results for the end investor. And to me, I think it's such a clear-cut argument in the sense that actually, for when you're looking at equities, a pre and post-trade tape is going to be materially beneficial. So then the critical element is, okay, what's the other side of the argument? Well, it's a commercial vested interest, which is not actually benefiting the end investor. And I think that's where there needs to be the challenge of the multiple millions and billions that is being made from this, and you need to be able to look at the democratization of data so that people can have fair and effective pricing coming through. And I think, for people who are actually looking at the policy around this, I think that's the critical point where you need to look at yourselves and to think through what is the right results for the end investor here. And I think it's a clear-cut answer.
Thank you, Matthew. Again, we see the questions coming in the Q&A tool. We have on the phone, not on video, unfortunately, for some unexpected IT reasons. We have on the phone Philippe Guillot. As we said, Philippe is managing director and head of markets and data at the IMF. Is on the phone, and I think he can hear us very well. We would like to bring Philippe, if he can hear us on this topic. You missed the first part of the session, Philippe, but from what we are hearing from Keshava representing the buy side and Matthew representing the sell side, and also Nikki, the tape is definitely a key objective for the completion of CMU and should be a top policy priority. They're also saying that pre-trade transparency is not such a difficult thing. A pre-trade transparency tape for equities is not such a difficult thing to put in place. What's your overall views on indeed the tape as a policy objective for the EU, and more specifically on the setup or establishing of a pre-trade transparency tape for equities?
Can you hear me?
We cannot see you, unfortunately, but welcome to the session, Philippe. Please go ahead.
Thank you, Pedro. For those who do not know me, you don't miss much. Don't worry. Regarding all the questions you've raised, yes, it's a priority. It needs to be done. It's something we consider is a missing cornerstone of the CMU. In terms of timing, it may not be done in the coming weeks. If I can give a bit of a hint, there's the French presidency at the moment. It's very unlikely that the French presidency will finish the work on the MiFIR review. It will be passed to the next presidency, who will probably not be able to complete it as well. So I would expect the Swedes in the first half of 2023 presidency to complete the job on the MiFIR review. So that means that it probably leaves us another full year of heated discussions regarding the consolidated tape. From what I gathered in the previous minutes, the technicality of making the console tape for me is available. You probably have many different people or potential providers who have the technicality, and it shouldn't be too difficult for them to do the tape, or for somebody to choose from those different offers to who's going to make that offer the technicality of the tape. What is really complicated is the governance, as you said. And for me, if you do not have a proper governance beforehand, then you will never reach the stage where you will be able to choose from the different technical offers, and that governance is really critical, in the sense that it needs to take into account many vested interests, and somehow you will not be able to reach a proper governance agreement if you're not taking into account the vested interests, somehow maybe buying them out of their current vested interest in giving certainties for the long term in that governance, and making sure that when you are doing things, you do them in I would say in sequence. If you look at the current revenue stream from exchanges, you see that they are making much more revenues from pre-trade data than post-trade data. So if you want to get all the market, all the stakeholders, or the participants, the buy side, the sell side, the trading venues, the data vendors around the table, my advice would be very much to concentrate firsthand on the post-trade real-time console tape, where you have less vested interest, less revenues, and it would probably be easier to reach that governance agreement. Start focusing on that, making it work. And after that, if we have a structure that works properly on that post-trade with a proper governance, with proper technical solutions, with properly cleaned data, then only in the second wave, start working out to see if that nice governance and nice structure that works on post-trade real-time data could be somehow extended to pre-trade data. And we have the next year to work on that. The coming year.
Philippe, thank you very much for your thoughts. As moderator, I should remain neutral, and I will. But I should say that probably the first time I heard that the vested interest of industry stakeholders may need to be bought out so that policymakers can make policy. We do have 5 more minutes maybe to wrap up the session, and we have this issue about the governance so important, including the points made by Philippe of the need maybe to share some revenues to address concerns from some industry stakeholders. But we also have questions coming in the Q&A tool, and they mostly address 2 topics. One is considering that the tape has not emerged so far, and it looks as difficult to find a business model, should the tape provider not be a public institution? And also another question is that to what extent the consolidated tape could fix the issue related to increasing market data costs. So all very important topics. In 5 minutes between the 3 of you, Nikki, Matthew, and Keshava, maybe starting with you, Nikki, on the issue of the governance. How would you respond to Philippe, and what would be your thoughts?
So I think it is important. There are 2 questions from the audience here that talk about whether or not this should be a public service or a public infrastructure. And my view is I agree entirely. I think that this idea that we're going to have competing tape providers is just in la-la land, and it's not going to work. And so this needs a single body. As we've all said, the technology is available. So this is about providing governance, oversight, one body that can see where the data is going wrong, that can fine people, etc. So I think it does need to be the single body. In our report, we recommended that this was actually a public-private partnership combined. And by that, what we meant is actually that we asked industry participants to fund this entity, and it should be exchanges, broker-dealers, anybody who is actually producing or aggregating data and then going to provide it to the consolidated tape should have a seat around the table. That includes the exchanges who have the vested interests and the others, people who are complaining about costs, etc. they all need to sit in a room and negotiate between themselves and fund this entity, which would then have oversight by, in my head, this would be with ESMA on behalf of the whole European markets working together. And so I agree with Philippe that actually, you can't just expect people to give up their data for nothing and not know what they're getting back. These are now, unfortunately, publicly listed companies. They are for profit. This would have an immediate impact on their own shareholders. But I think we can negotiate. I'm not sure whether we need to buy them out, but actually we could all sit around the table and say, okay, look, let's just be really clear. You're going to have to make some sacrifices. We're going to have to make some sacrifices. Maybe the data doesn't get down to the price we need for the first 3 years, for example. Maybe you get awarded an extra amount for putting your data in the first instance, but over time that needs to come down, and we address those expectations and issues. By the way, in our report, actually, we said that this organization could be set up at the price of 23,000 euros per entity, so that's per broker-dealer and per exchange, and then on a running cost of 16,000 euros, and that would have a staff of 25 people who would be working for this individual entity. This is not an expensive thing to set up and could easily be funded by these organizations. But I do agree, it's like the peace negotiations at the moment, isn't it? You have to get people around a table. Everybody has to be prepared to compromise. That is what negotiations are about. So in agreement to those two questions about why isn't this a public service, yes, I think it should be a single entity, whether or not we call it public or public-private. We can debate that, but I don't actually believe that competing providers is going to be the solution for us.
Thanks, Nikia. And just to wrap up, Keshava and Matthew, maybe starting with Keshava, any immediate thoughts with this, and we wrap up with Matthew later.
I definitely agree. Single model, even when you look at the US, they start with single model. Even now they're looking at the competing. There's a lot of challenges. I think in our fragmented market, going for competing model as a first step, I think is filled with problems. I think we should start with single model, though everybody believes in that competing model for the benefit. And also going back into the pre-trade as well. I mean, I was just thinking about what Nikki said about this consolidation of price comparison website. There is an argument, people saying by getting the pre-trade trade, the exchange will lose out. Actually, if anything, on the pre-trade, it gives you the overview of where the prices are. When you click on them, the insurance website takes you to the insurance actual provider. You trade on the insurance provider's website, not on the comparison website. So the pre-trade will give you, here are all the best prices available. When you need to trade, you don't trade on the CT. You click on the CT, it will say, okay, the best price available in Euronext, Deutsche Börse, Borsa Madrid, wherever it might be. You will trade there. It actually does not in any form or shape, and have any kind of impact or a negative impact in that sense. But I agree that, as Nikki said, I think as the whole industry vested interest, and also to grow the capital markets, again coming back into that with the volume growth in Europe compared to the rest, everybody should focus on, rather than being 10% of 100, be 5% of 1,000. That will help everybody to grow.
Can I just be really clear on one point? Sorry, Pedro. Just everyone talks about the fact that the US may now be moving to competition. It is not moving to competition in the setting of standards, in the enforcement of rules. Nothing is going to change in that. So I think we all need to be really clear about what competition actually means. And one of the other questions has been about what's going on with the private providers and developers of a consolidated tape. Well, the answer is they can't really move forward until we have that single body doing all of the things I've just mentioned. Sorry, Matthew, in case you wanted to add something.
2 minutes, Matthew, just for you to wrap up on both sort of the governance, but as well as on the question on whether the tape would be helpful by any means to stop the increasing market data costs.
Sure. So to wrap up, I think I find it very challenging, and just to echo surprise from your point, Pedro, when you're looking at promotion of competition in terms of across venues, worrying about protection of certain entities. I find these are not state-owned. These are utilities which are commercial entities, and as Nikki said, are publicly listed. And so I find that very challenging. And going back to the point, if you have good liquidity and depth there, that will be shown out through the consolidated tape. So a forward-thinking entity would embrace this and embrace innovation and embrace challenge. rather than something that's trying to drag things backwards. A single entity, completely 100% agree. There's another element to this, which is around a authoritative source of data, or a golden source of data, because as if we said that you're going to have to aggregate things, there are going to be different elements in terms of how it feeds in. So it's really important that you have that authoritative source out there. Technology, yeah, let's go private, because let's face it, that's where you get the innovation, you get the evolution. And so I think it's really important that you can actually adopt private technology through a single entity with appropriate governance. Also, get the industry around the table, and with regulators to make sure that we have this governance structure in place and we can utilize from that. We bring the real experts in to look at, okay, I've got a problem with tag 851 and this is an issue here. Now, I'm not going to go into what tag 851 is, but the key thing is that what we need to do is we need to have the people that understand what tag 851 is, so that actually you can then have that conversation and look at the nuance of what's happening in the market, so we get an accurate reflection and we hit that objective of what's coming through. Reduction of market data costs. From my perspective, in terms of from a front office role, we run very complicated algos which are hungry and low latency data. We will still be getting our direct feeds. The consolidated tape will not be a solution for that. Having said that, there are functions where we are going to get and we will have better data coming in, and it will reduce our costs. So market data, market abuse surveillance, risk management. We don't need that extreme low latency data. So that will be able to us to give better sources of data and to put more effective controls in place as well. And I think that will put some benefits in. And also, I think overall, in terms of from the asset manager, it's going to reduce costs. It will put better benefits in place, because not everyone needs the extreme low latency solutions that are provided. So it will provide some solutions to the cost of market data. Unfortunately, it's not going to solve all my problems, but at least we're helping to solve some things for the end investor.
Well, a lot of things still to be discussed. This has been an extremely interesting debate. We could have stayed for...
Could I have a quick word, please?
Philippe, please come in.
Yes, just
in 1 minute if you can.
Before you, before you conclude, I just want to remind everybody that there is a fallback solution that is called ESMA, and if nothing happens, ESMA will have to do something in a few years' time. That reminds me my situation at home. I usually do the cooking, but if my wife says I'm hungry, I will do the cooking in 2 hours time if you haven't done anything, I know it's better for both of us to find a solution, be it restaurant takeaway or do the cooking myself. So we want to find a solution before ESMA's fallback.
We should indeed, and as I was saying, a lot of things to discuss still. It has been extremely interesting. We could have stayed for much longer, but as we passed the time, we maybe we'll continue next time, maybe for a third webinar on yet another MiFID topic in the coming period. I wanted to thank all the panelists for their participation. Thank you very much all, and the audience for the interest. Before closing, I just wanted to remind participants that the recording of the event and the slide deck will be uploaded to our respective websites so that everyone can access what we have discussed. And with that, I want to thank you everyone for their participation and wish you all a fantastic end of the week. Many thanks, everyone.
Thank you. Thank you, Pedro. Thank you,
Thank
Nikki.
you.
Bye.
Thank you.